the concept of market function is just, it really just moves on in balance of supply and demand. Market will always trade in a range. And again, it's just really figuring out your risk and reward. And there's a lot of questions about time frame, and time frame really just depends on what you're looking at, and it is all relative, right? So if you're looking at, say, the 15-minute time frame, you should be trading on a shorter time period. Say if you're looking at like a daily, that would be more ideal for like swing trading. And I really think, again, like it's important to have, where if you are short-term trading, day trading, always have a stop loss. Mine's around 20-30% adjusted depending on how volatile the stock is, also depending on my position size as well as the intent of my trade, right? So if I wanted to own, say, I don't know, CCIV out long, like April, March, whatever, right? Ideally, it makes sense to start a position, and that's the idea. That's the concept of sizing in. Say you want to own 10 contracts, you would own 2. If it dips and it's still in an uptrend or still in your technical setup, buy the dip. And it's easier said than done. I think there's a lot that goes into like a trade, in my opinion, rather than just buying. I really think that what gives me most conviction is seeing large orders, seeing the order flow go with my position. So, for example, we're still trading CCIV and I'm seeing like 10 million, call orders going out for like November, for example, right? That's telling me, one, there's a large player that is very bullish on CCIV out to November. And if I was long and, technically, if the setup gave good risk to reward, it would make sense to go long. And, again, like if you're seeing these large orders come in, the big boys are likely the ones moving the market. And so the idea is, again, just to kind of go where if like someone has like $1 million bet and you have like a 1K bet, who's the one that really will get emotional or yeah. But again, like people with deep pockets will likely have more information than you, and so if they're putting on larger sizes, again, it's just more conviction to go with the directional bet. And obviously don't just trade solely on where the flow is going. Obviously analyze your risk reward. And yeah, so with that being said, I guess we'll just move on. So I do want to touch upon trading areas of liquidity. So price, the way I like to view the market is so price actually moves 2 areas of liquidity. I have it. It's highlighted, blue, red. Sorry, I didn't read you. So it's highlighted in. You can see it in the red and the blue on the diagram, but I personally highlighted what I would be looking at on by the green charts, the green boxes. And so, ideally when you're looking at this chart, you basically just have price action move to these areas of liquidity highlighted in green. And so how price likes to move out of this is typically when it hits that upper limit of that liquidity zone and there's volume to move price higher, there's likely going to be a push back to the area of liquidity above or below, depending on current market conditions, as well as interest of buyers and sellers. Anyone has any questions on this, let me know. But I think this is something I touch upon pretty much every workshop. Areas of liquidity, just basically areas of where buyers and sellers congregate together. How do I know where the green box is? Good question. So typically what you're looking at is historical data. And so, for example, we're using this box, you can see that really using the close and basically the bodies of the candles within this range. And so like, I can't erase this right now, but if you're just looking at price in this range, you can see that we do have this consolidation within this range. You have an upper and lower limit. So basically you can see that, for example, if you're looking at price, we had this basically where I would say majority of candles were closing around, basically just looking at for support. Oops. If you're just looking at it from support and resistance lines, you can see that there's support running through this area here at the bottom, and then you have resistance at the top. And so when you're really just looking at areas of liquidity, demand or supply zones, you're really just looking for, again, areas where price consolidates. And again, I like to look at it as where, like, area of interest for buyers and sellers to get together. And where price moves afterwards is, in my opinion, the true directional move. And again, that is really dependent on volume. If there's a strong breakout above the upper limit with volume, then there's a likelihood of a strong directional move to the upside. Same with a breakdown, right? No volume, imbalance of selling, no one's picking it up, then you'll likely have price move back to liquidity below. I hope that answers your question. All right. So two concepts I want to touch upon. So areas of liquidity, right, and absorption. So when you're watching price, you really got to be thinking, what I'm really looking for when I'm watching price action is the velocity, how fast is the order book moving, and volume by definition is just activity. And so when you have increasing, when you see the order book just moving faster and faster, picking up speed, volume is likely ramping up. And so again, like, that could be a good or bad thing, but again, if the technical setup is bullish and you're seeing, basically all the dips being bought, then, probability wise, it makes sense to go long, vice versa. And so on this diagram, right, you can see that you have this overhead resistance, price got rejected. And you have what I have here in this green area, basically a liquidity zone, right? An area where price consolidates, price buyers and sellers congregate together, right? And so what you're looking at here is you have this sell-off, or sellers push this lower, and this quickly got absorbed, right? You can see it by the next green candle here. And again, this is very normal. It's very normal for price to move to an area of liquidity because this is an area of interest for buyers, and for price to bounce up, right? We've all seen this. And so again, like the true test really comes whether or not on the next candle, whether or not, buyers are going to hold this area, push price higher. And again, that comes down to the volume, how the technical setup looks like, order flow, how bullish, bearish option flow is, what's the order book is, are there large buys coming in? Is it being propped up by, small lots? For example, if you're looking at, let's use QS or CCIV as an example again, right? If you're looking at CCIV, and again, like when you're watching the order book, you really want to be paying attention to anomalies or where the large orders are coming through, right? So, for example, let's say I was bullish on CCIV, and clearly on an uptrend, but I'm seeing this large seller selling 500K sizes here and there. It's not affecting price action too much, but I'm clearly seeing someone just dump their shares.